That's right. Look, it's a few minutes past 12, so I think now's a great time to actually kick off. I know everyone's time during the day is valuable, so to all the attendees, the people that have jumped online, thank you very much, and welcome to the second edition of what we're calling four-quarter finance. So we do these updates every quarter, and just as I've just been chatting with Jason and Jonathan, you know, we are living in some pretty extraordinary times, and you know, we're just doing everything we can to drag ourselves out of this global pandemic, and you know, one that we thought might last initially for 1, maybe 3, 4 months, it's now pretty much 2 years on, and of course now, you know, we've throw these global conflicts into the mix, and the floods up in Queensland. It's a very uncertain time, and a very, you know, for some people a very worrying time. So I mean, it's great to catch up with Jason and Jonathan today and try and pick some of this apart. And you know, and even as I said I put this, you know, a comment on LinkedIn this morning that, you know, the priority or where our minds go to, you know, first and foremost is the human element of what all of this, of what all this has done to people. But of course we can't ignore the economic implications, because it's a bit of a circle, you know, that feeds back into people's ability to earn a dollar and continue to help, you know, live a life. So very important and timely catch up. I'm just going to quickly, you know, best we get into this discussion as quickly as possible, make the most use of the time, which we hope that'll run for about 40 minutes thereabouts, and then hopefully we've got time at the end for any questions from any of the people joining us. Jason Todd, welcome to you. For those watching today, Jason is Head of Wealth Management and Investment Strategy at Macquarie Bank. You began your career with JP Morgan as an equity strategist back in 1996, remained with JP Morgan until 2007, and then you joined Morgan Stanley New York as US Global Strategist, where you remained until 2010. And then, of course, I'd say, just skipping, you know, more recently, you've joined Macquarie. So welcome to you, Jason.
Thank you.
And Jonathan, you're a senior economist with Ernst & Young. You work alongside the chief economist and EY's valuations, modelling and economics team. You play a key role in shaping EY's economic narrative, measuring, analysing and communicating Australia's macroeconomic climate. So I'd say we've welcome to you, Jonathan. And I'd say, you know, we're very well positioned to have a great conversation today. Without further delay, I'm going to kick straight into it. So for the viewers there, we're basically going to run a Q&A. I'm going to direct certain questions to each of our panelists today, and I'm also then, I suppose, I'll invite, time permitting, I'll invite each of you to make a comment if there's something that you'd like to add to a question that you perhaps haven't been directly asked. But the first question is actually to both of you, and Jason, I'll start with you, and then Jonathan, on to you after. The war, as we've just talked about, occurring in Europe, it's complex, and there is its global economic impact, no doubt, depends on a lot of factors such as duration and severity. So Jason, are you able to provide a comment on what this might mean for global economies?
Yeah, look, I don't want to simplify this, oversimplify it, but I will. Is that you know, if we go back to 2009 or post GFC, there's been 74 geopolitical or sort of, you know, risk events that the global economy has faced, and in every one of them, you know, we've generally been able to get through it without too much of a prolonged downturn. And the reality is when we think about the implications of what's going on there, clearly it's a function of whether it escalates or whether it doesn't. So I think the easiest way for people to think about this is just to take the current situation where markets and economists, etc., have generally priced in a relatively contained, short duration sort of war. And the economic implications are pretty low, are pretty small, I should say. They're a little bit larger for Europe, obviously because of its linkages into Russia, but for the rest of the world, exports into Russia are pretty low, and financial flows are also pretty low. our estimates is that that for this type of contained conflict, there's about a 0.5% implication for Europe, but for the rest of the world, it's largely irrelevant. Now, it can become larger, obviously, if we start to see this escalate. But the part that we don't quite know about is the indirect effects. So the direct effects, pretty minimal for the rest of the world. The indirect effects is really through commodity prices. We kind of know that, oil and gas. And ultimately, that's when we start to see sort of second round effects become more relevant for those which don't have direct implications or exports or financial flows with Russia. And from this perspective, again, this is almost like how long is a piece of string? How high will oil prices go? And at this stage, is it a worry that oil's at $100? Yeah, it's a little bit concerning when we all go to the gas pump and those types of things, but is it a real worry in terms of how we're seeing the implications for growth or financial markets? Not really. I think that we've seen now some commentary suggesting that if this escalates, we could see sort of 2006 peak oil prices exceeded, which was 146 for oil. It's not really the price; it's the proportion of income spent on oil that actually matters now. But essentially, sort of, if we get to those scenarios, I think it could be reasonably influential in terms of sort of having an impact. Again, not a lot long in the duration, but the offsetting factor for people to understand here is just that the downside insurance that was provided by central banks is always still there. Will they be concerned about inflation, and hence will they actually move proactively to actually pause policy sort of direction because of this? I doubt it. But if they need to, and they judge that the implications for growth are more important than sort of, what we might see for short-dated commodity price inflation, then we might see that. So bottom line here is that I think that markets are looking at it in a way that they believe that this is quite short-dated and contained. There's nothing wrong with that, because I think that if it stays this way as it is now, that is the implication. For Australia, relatively low, meaningless. And for the US, relatively meaningless. For those who import oil and gas, probably a little bit more significant.
Okay, fantastic, Jason. And Jonathan, how about yourself?
Oh, look, I think Jason's done a pretty good job at sort of talking through quite a number of the issues there. I suppose the way we've sort of thought about it is, I suppose, in 5 different buckets. There's the sort of financial market impacts. Obviously, there's what we've seen in the equity markets, a bit of volatility up front, a bit of flight to quality and safe haven assets, and US dollar and the like. There's obviously the energy price impact. Jason just mentioned oil, but there are implications for gas and coal, as well as given Russia's significance in those commodities, and that has implications for Australia, largely through higher commodity prices, which is maybe a positive for Australia. The same for agricultural prices. The Ukraine and Russia both play a part in the agricultural price sort of area. Ukraine is the largest European producer of cereals, so that's sort of wheats, barleys and corns and the like. And again, Australia is sort of well positioned on that front. Global growth is the 4th bucket there. And as we've sort of mentioned, it's a minimal impact, mostly unevenly spread, and that'll be mostly in Europe. And then the 5th bucket is really around sentiment and business confidence and consumer confidence. So that sort of bucket is the great unknown. You don't really know the impact of that, and that's that second round effect. It's not a direct thing you can measure, but if people make a bigger deal of it than what Jason has sort of outlined there, then it could have a bigger effect, essentially. But those are sort of the 5 buckets we think about.
Yeah, beautiful. Thank you. I mean, just quickly on that, obviously we all do a little bit of reading and educate ourselves about this conflict. Was I right in reading that the Ukraine supplies 30% of the world's wheat supply? Is that right?
Yeah, it's pretty focused on things like wheat, barley, and corn in particular. Corn is, I think, its biggest cereal export. So when it comes to those particular commodities, there's some pretty big consequences. I think you can even see in shipping prices in the Black Sea area have started increasing as well, which is where about a quarter of the world's wheat trade has done. So there's some very, I suppose what we get out of this is it's an uneven impact on particular commodities and particular areas of the global economy.
Yeah, and that's a good, I mean, I guess it's somewhat of a segue. Jason, I was going to ask you, which I know you've talked about oil supply, you both have, and perhaps the relative benign impact on places like Australia and the US. But those that filled up over the weekend, certainly I'm sure in all parts of Australia, in Melbourne, it was $2, $2 a litre. It's back down now, but is it accurate to estimate that Russia supplies about 10% of the world's oil supply? And I'm guessing by what both have just said, that could possibly impact Europe more than anyone else. How do you think if there's a need to fill this gap, does it fall on, OPEC to increase supply to fill that gap, to sort of try and control the price there for parts of the world?
Yeah, look, I mean, the numbers that you've quoted are actually correct if you base them off 2020 production levels. Actually, Russia was the second biggest producer at just over 10 million barrels a day, and the US was about 11.3, I think, and then Saudi was just below 10 million. So you're correct there. I think the issue here ultimately is whether there actually is the capacity to fill partially or if not, sort of in totality. In totality, it's highly unlikely. We think at Macquarie, Jonathan might have a different view, but it's highly unlikely. We believe that you'll be able to fill 10 million barrels, if not sort of even after a long period of time, but certainly not after a short period of time. Partially, can some of the supply be filled in? It's going to depend, but we put it down to sort of 4 things that might actually be able to influence your ability to fill this sort of void if you get to that stage. Firstly, it is in terms of whether OPEC can pump a bit more. There is a bit of capacity there, but it's not 10 million barrels, right? We're talking sort of a few million barrels at most, and even that might be a little bit problematic. US shale could pick up some, but again, sort of, given that there is a price incentive, but to some extent it hasn't happened already. The people are talking about an Iran deal, which would add, I think it's just over 1 million barrels in terms of their production. So that's the third one. And then you could see some strategic release reserves from both China and the US. But again, these are very short dated sort of, influences here. What we would say is that, or our oil guys would say that, if you were going to OPEC, it would still probably take between 60 to 90 days to start really sort of guaranteeing that supply to sort of, when you've got to get it out there. And clearly any deal with Iran is going to take even longer. So what I'd just say here is that I don't feel that people should be encouraged that you're going to automatically be able to just fill that void in terms of just a partial or a full supply. Probably more problematic for how we see this would be the gas side of things, because in fact there is just no real substitutes for them, and Europe takes a much bigger proportion of that, so that's probably more concerning for us. And Jonathan might have some thoughts, but basically what it's almost sort of ironic here is that we talk about the risk reward, thinking about the commodity side. And if I was thinking right now how to play this just in terms of risk reward, if this is a very short war and things sort of, go back to normal, maybe the oil price gets down to, $80, which is where OPEC kind of feels that it wants to see that oil price. But if this explodes, that thing's going up another $50. So we can, bad is oil going incredibly high. A good outcome now is it probably drops back. You see 15, maybe $20 oil premium come out. So that's how we see the risk skew there, though.
No, I appreciate that. Thank you. And I mean, we could unpack a lot of these individual questions, but we've got a limited supply of time, so I'll keep moving on. Thank you, Jonathan. A couple of questions for you. The COVID response in the Western world was largely consistent with lockdowns and government financial support through essentially the printing of money and ensuring it's made its way into the economy. Provision of rental and mortgage assistance and of course low interest rates and so on. In December, so we're just going to, final couple of questions about the global sort of situation, then we'll come back closer to home. But In December, US inflation hit 6.8%, which is a 39-year high. Just, again, breaking it down for everyone and keeping it quite simple. What's caused this?
Yeah, and I think you'll find it's actually gone a little bit higher even now. So it's up in the sevens sort of in the US. So I mean, I suppose I guess the essence of the question is, where does the US stand relative to everyone else in terms of inflation, and are we likely to see that even here locally, right? And I suppose the first thing to say is that the US is sort of the outlier in this sense, that they're right up there in terms of inflationary outcomes on the global scale. Sort of Europe has seen a definite lift in inflation up in the around 5% zone and the like, but not into the 7.5% area. Australia has seen inflation around sort of 3.8% at its peak. And then Asia has actually seen very subdued inflation. So it's again a not even outcome across the globe. And some of the reasons why the US has seen this acceleration in inflation has been specific to the US, and some of it has been global. One of the things we're just talking about is oil. That's common across all of the countries that we've been talking about here. We're talking about Europe, we're talking about Australia, 30% rise in petrol prices. You just mentioned $2 on the weekend. And there's the increase in shipping prices, there's an increase in semiconductor chips, and the effects that's having on things like motor vehicle costs. So all of that is sort of the global aspects to it. But I suppose there are those specific things to the US, which are this lift that we've seen already in wages growth in the US. It's something that we haven't seen here in Australia. We've also seen this great resignation trend, again, something that we're not seeing in Australia, where you've seen a very large group of people in the US, mostly elderly and female, dropping out of the workforce. So there's that lack of supply of labour there. So I think in general, there's, and I suppose the last final thing I'd mention is just the amount of stimulus that the US has put out into their economy. It's at the top end of the advanced economies side of things. And additionally to that, there is this plan for a large infrastructure spend as well. So the US has got its unique characteristics, which is driving it to the top end of the inflation spectrum. And some of those things we don't think will transpire, I suppose, in Australia, and it's probably a reason why we don't think we'll see inflation sort of accelerating to the same levels in Australia.
Okay, thank you. And we're going to move to the domestic discussion in a minute, and we'll keep talking about inflation, inflationary pressures. And final question for you from a global discussion. I didn't want to leave the global discussion without, just perhaps looking at the impact of not just climate change, but various countries' commitment to move towards net zero emissions in the future. Now, given 20% of Australia's annual GDP comes from exports, and within that 15% coming from non-rural commodities such as coal, metals and fuels, etc. Do you have a view on the global economy's desire to move towards net zero targets to have an impact on our exports over the longer term? Possibly?
Yeah, I think it's probably one of the greatest, I suppose, structural trends that we'll see over the rest of our lives, I suppose, is the shift towards net zero. And more countries around the world are jumping onto this trend. You might think that currently some of our trading partners have sort of committed to a net zero, but even more and more as we go forward are committing to a net zero commitment. So you think about India, you think about China as some of those big global players that could possibly take some of our sort of high emitting exports. And it's going to be a challenge for the Australian economy and the Australian export base, because over time we've become more and more reliant on the high emitting sort of exports. So what it will take is a significant, I suppose, structural adjustment in terms of what we rely on from the export side of things. And some of it's really just out of our hands at this point, right? A lot of the local debaters around sort of uncertainty around closing coal-fired plants, or not giving permits for new coal plants, or new coal mines rather. And it's really kind of a lost cause debating it at the domestic side of things. I mean, from our numbers, it seems like 66% of the risk from a net zero economy comes from in terms of the negative sense, comes from the global side. It's only a small 30% of the risk really comes from the domestic transition. But in saying that, there's also all of the I suppose, positive investment opportunities that we have to look at, and that might be a global where Australia can fit in it globally. I suppose there's the hydrogen opportunity, which is obviously something that's much talked about, but has not yet delivered in any way at all. But it is an opportunity there, and these are the things that I suppose we would like to see Australia and I suppose the government even in general supporting as we make a sort of transition to this new global economy.
It's in some respects, I guess, it's the balance between investing in the long-term future of what's in the best interest of the country versus getting elected in the short term to some degree, because sometimes the people who are relying on those industries, they're focused on the here and now, which makes sense, but makes it a complicated sort of issue.
Can I make a point on that, Andrew? Is that I think that it's easy for us to actually to have support for this narrative at a time when we've come out of the pandemic and everyone we've focused on social issues, we're focused on climate issues, and everyone is in agreement on this. I don't think that the will has yet been tested, and I think we should be careful about this. I'm not suggesting that we're not going to sort of continue to make improvements, but I would ask very simple things here. Is that are we going to see, not on climate, but I'll use this and move towards it, but are we going to see employees continue to pay people, higher wages if things start to slow down? I don't know. Probably not. Are we going to see, continued sort of thrust of this occur if the cost of capital goes up and that makes a lot of these projects more marginal? I don't know that. Are we going to see it if we actually see a split government, right? And actually, we start to sort of have a polarization in views? I don't know that either. And if we actually do go through a period where maybe we get asset prices falling and people's confidence is just not particularly high, right? And they actually stop there, and we all want to go out and buy an EV, but we replace our cars when we've got money. So I'm not suggesting that we won't get there in the end, but I think we should be careful about sort of just extrapolating this incredible sort of momentum that we have now into the future, because a lot can change.
Yeah, no, it's a fair point and a very complex issue that I'm glad I'm not dealing with firsthand at a government level. But look, and moving, again, so we're talking about some of the implications domestically, Jason. There, moving on to you. Let's talk about inflation. Maybe an obvious answer, maybe not, but is Australia's inflationary pressures caused by the same issues that we're seeing globally, and to Jonathan's point, in the US?
Well, look, I think that there is enough of them that are similar to be able to say yes. Whether they are impacting to the same degree is more questionable. And I think that differences in terms of the economy, but also how the economy has actually operated over the last 2 years, which has meant that Australia has been in lockdown for quite a period of time. So we haven't seen real wage pressures coming through. And secondly, I think that part of the big contribution, part of the thing that has helped Australia with lower inflation has been the policies that have been specifically related to the housing sector. So which has kept sort of, those CPI components of housing, which is the construction costs of housing because of what was going on, and rents, etc., lower. So there's been a few one-off things. But we wrote a piece sort of, in October last year, just looking at the way the world was going historically thinking about how correlated things seem to be with Australia. We all want to think that we're the same country, but we're not. We're subject to global forces here. And we just said, forget about what the RBA tells you, forget about what the CBI tells you. What are you seeing when you go into the supermarket, when you fill your car up? Are you seeing high prices? The answer is simple, right? Yes. And even to Jonathan's point, I think it's a moot point, and we want to be careful about getting tied up in this idea that we won't have as high inflation as what we've seen offshore, so that's actually fine. It's not fine. Actually, we are going to live with higher inflation. It might not be high inflation, but it's going to matter in terms of how people are sort of thinking about what's going on. But from my perspective here, we can pull out all the reasons why inflation's going up and these types of things. But when we think about it, really, we went through an extended period of time. So whether it was just post GFC or even longer, where there was insufficient demand in the world to actually generate inflation. Then we had COVID, and suddenly we've got inflation. And sort of, what are the dynamics and what does that actually really mean in terms of thinking about it from either an economic perspective or a markets perspective? And a couple of things here is just that inflation is not necessarily a bad thing. Unexpected inflation or high inflation is a pretty bad thing. But if we were to get inflation now at between 2 to 3% versus the last 3 to 4 years where we haven't even been able to get any inflation, is that bad? No, that's not bad. And the second thing I'd say is if we get a bit of wage inflation, that's fantastic. All the gains of an incredibly robust global growth world in the last sort of decade has gone to corporates and shareholders. Why shouldn't workers get a bit out of this, right? And so the wage share picks up and these types of things. So I just almost want to say this is that, and don't be misled by almost thinking that because we don't get high inflation like the rest of the world, that our inflation backdrop's not changing. It is changing. Is it sustained? We will see, right? And basically, I'll say this is that what we watch out for is obviously a really elevated sustained inflation. But what we also watch out for is unexpected inflation. But also what we don't want is breadth in price pressures. And we can have an environment here where we actually start to see a little bit of pricing pressures come through, particularly on the wage side. But as long as it's not across, everything where you're seeing 30% increases in the price of cereal or because you can't get the wheat, those sorts of things, I suspect that it's not that bad. It's not, it's not generally always great, but it's probably, I think we can live with that. And in fact, considering that in it feels like almost in my entire working career of more than 2 decades, the problem that we've always had has been no inflation. I don't know, a bit of inflation.
So just explain, and sorry, John, I'll just ask this question because I think it's one without notice, but it's really important. I think it's quite important because I suppose you could say that there is this narrative that there's a concern and it pushes out the fear that inflation is a bad thing. But in general terms, and maybe COVID's not normal because of what's caused it, but inflation generally means we've got a healthy economy, does it not? We're saying, Jonathan, you're nodding. Do you want to have a quick answer of that one?
Yeah. Look, I think it's exactly what it means. The RBA targets not 0% inflation, not 1% inflation, but 2 to 3% inflation because they have judged that is the right amount that says, well, the economy is operating at its potential. We're not wasting not using the resources that we have around us. That means we're using the unemployed people, that getting them into jobs and making them more productive by giving that connection to them. We're using the capital that is sitting around, and businesses are actually investing money and making money. That profits are increasing because we've got an economy that is operating at its potential. If we had an economy that was far away from its potential, performing underwhelmingly, then you get some adverse outcomes. I suppose one of the things Jason just mentioned has been that a slow grind of the profit share of income sort of rising over the last decade, which hasn't exactly been a really strong thing for the Australian economy. It hasn't been a strong thing for people generally. The per capita GDP has been struggling for quite a while. We've had some per capita GDP recessions, in fact, and people won't talk about those, but having an economy that is operating at its potential with a little bit of inflation is a sign of a strong economy. Yeah.
Okay, fantastic. Now, I'm in the midst of building a new house at the moment. The slab goes down in the next couple of weeks, so particularly interested in the construction industry. So, Jonathan, just staying with you for a minute. We've seen this, using construction as an example. We've seen a supply contraction for the reasons that have been mentioned already. Supply chain bottlenecks, the inability to transport, etc. Obviously, this adds to our inflationary woes, because you do see, and certainly from my experience, I've seen a sharp increase in materials. Do you believe that prices will settle back down to where they were, or settle back down at all? I mean, that's what we call transitory inflation, is it not?
Well, I suppose there's a couple elements to that. I'd say the answer to, and this is a true economist answer, is it depends. So it depends on what you're talking about specifically. So if you think about, for example, petrol prices, now we've just mentioned that they might accelerate a lot from here, but assume that they don't go up another 30% over the next year like they did over the previous year, and they settle down to 5% or 10%. That's disinflationary, right? So there's less growth in that product. And then I suppose what you're talking about there is sort of this deflationary concept, right? Where you might see prices actually decline back to their previous levels. So you think about computer equipment or audiovisual sort of technology has been declining for years, for decades in price. Some of that is because the quality of those things have been increasing, so the sort of ABS adjusts for those things, but the price of those things has been declining for a long time. And during the pandemic, we've actually seen them increase in price, which is very unusual. So in those sort of products which we think are responsive to the changes in supply and demand, it's very likely to see sort of deflationary pressure coming from products like that. I guess when you look at the CPI basket at the moment, a very large proportion of the products in the basket are ones that are unlikely to see this deflationary force. They tend to increase in price and they never really decline in price. They might slow in growth, but they don't decline in price. And they're also all showing sort of larger than normal inflation. So construction prices is one of them, which is sort of the fastest growth you've seen since the GST was introduced, so more than 2 decades ago. And a lot of that is supply side, lack of materials, but it's also this demand side element, which I'm not sure if you got home builder, but one of the things that's really supported demand there is the home builder scheme as well, which is sort of working its way through the economy. So I mean, my outlook for construction prices is probably not one of deflation, but hoping a bit of disinflation, because it is acting a little bit as a handbrake on activity at the moment. It's a handbrake on people investing in their homes, and it's a handbrake on new investments. And I think we might even see some of that in the GDP numbers coming out tomorrow.
Yeah, sure.
It'd be hard to think that things like timber prices and building materials itself don't come down, a reasonable degree, right? There's
Sure.
been some pretty one-off factors that have driven that, but broadly speaking, don't disagree with what you're saying there.
Yeah, sure.
And I'm sure all those prices will come down after I finish building, but that's all right. Now, the other handbrake.
You don't quite realise that you're the one actually supporting those prices.
Yeah.
I didn't have a choice. My wife and 3 kids, well, 2 kids and one on the way, got to have somewhere to live. Okay, the other handbrake on inflation, of course, is going to be interest rates. Jason, I'm going to jump to you on this, just in the interest of kind of moving along to a 2-part question for you. And of course, Jonathan, you can add if you disagree or got a different view on this, let us know. Where do you think interest rates are going? When are they going to go, and how far do you think they might go? And the other part to that question, leaning on your expertise, is, there's a common belief that rising rates present a significant risk for the market, for listed companies. Would love you to provide a comment on whether you actually agree with this, and And furthermore to that, which companies or sectors could actually benefit from rising rates?
Okay, so this goes for another hour, doesn't it? So
that's a big question. Yeah.
Okay.
Well, you've probably got about 3 minutes.
So the first thing that I say is that every country and region is in slightly different parts of their cycle. So let's sort of talk about.
Let's go with Australia.
Let's talk about Australia, but first I'm going to just talk about the Fed, because that will ultimately matter as well. Is that look, the Fed's going soon, right? And we within the next sort of month or two. So let's just say that they're going. We think that they're going to go 6 to 7 times this year, which will pretty much be every time they have a policy meeting. So for everyone on this call, there is no reason for you to have any other view than policy rates in the US are going up and going up quickly. Does that actually matter? Well, the question is this, is that when you have real GDP at 6%, inflation at 7%, nominal GDP at 13%, and you have 10 or 11 million job openings that can't be filled, your economy is overheating. If you don't understand this, you are living in crazy land. And so they have to address this. So take from the starting point and the need for getting back to some semblance of just sort of normality where policy rates are is where we need to go. So the reason why markets aren't really sort of, being destroyed by the expectation that the Fed's got to raise rates 7 times in 1 year is simply because rates shouldn't be at 0.1. They are so far below where they need to be for that economy that it's catch up. So there's that part. And all I say is this, is where they go once you start to get to sort of, 1.75 or wherever, we have to wait to kind of see this. But let's also keep this in perspective here, is pre-COVID, the Fed funds rate was 1.75. It's now 0.1. You don't even get back to there when you raise rates 6 times. So, that's context for you here. And that is also why markets really probably haven't gone, oh my God, we've got a problem here, which there's a problem, right? Rates are too low, but it's not this thing that's going to really cause this big sort of into the cycle and into the equity bull market. So my other point there is that what the RBA does is not going to kill the equity bull market. It's going to be the Fed. And so we don't think that what we're going to see in the next 12 months is going to kill the economic cycle or the equity bull market from the US. So let's talk about Australia here. We've had the view ultimately that that Governor Lowe and the RBA are being a little bit too dovish on where they want to be. Will they be dragged into an earlier than expected rate hike? We suspect so. Is the market pricing in too aggressive in terms of rate hikes in May and then fall by the end of the year? Yes. So we think that the market moves back this way, that the RBA moves back this way. But my point is this, is who cares when the RBA starts raising rates? So we sit here and we procrastinate. Was it going to be August? Is it going to be November? Is it going to be January? I don't care. Who cares? We know that rates are going up. We know that rates are not going any lower than where they are now. So whether we're debating around 1 month or 2 months or 3 months, it's largely irrelevant. The point is that no one who actually wants to think about interest rate sensitive assets should expect to get lower costs of credit coming through. That is where we are here now. And so the same point almost applies for the RBA in terms of catching up, right? Its rates were 75 basis points. They're now 0.1. A couple of rate hikes will get you sort of there or thereabouts. But you have to remember here, for everyone again on this call, neutral rates, which is where sort of Jonathan was talking about when he was sort of talking about inflation in that band. Neutral rates for Australia, I don't quite know where they are, 2.5, or whatever. There is an enormous amount to go before we get there, and which means that until you get there, no matter whether you're tightening policy or not, it's still accommodative. It's less accommodative, but it's still accommodative. So you generally don't kill the cycle when policy rates are still accommodative, right? You just start to slow it down. So again, my next message is this: we're going to start seeing higher rates. I almost don't even think it's a debate. It's just kind of, let's put it back there. The question is will it really sort of, kill the equity market cycle at the moment or the broader economy? And the answer is no. And you have to understand this also, which is I get asked all these questions about, what's going to happen to house prices and what will the RBA do? And do you think that the RBA is going to keep raising rates into an environment where inflation isn't so bad and house prices are falling 15 to 20%, you've got to have rocks in your head to believe that. They're as much sort of, looking at the data and evaluating it as we are. So there's that part. So last point that I'll make, because I know I talked too long, is from an equity market perspective, is that understand where we are in terms of how we think about the progression of changes here. We have gone through the sort of the recovery phase of the cycle, a little bit of the expansion phase. We're probably getting into the mature phase. So that's the third phase of the cycle before you get to a downturn. What happens in the mature phase? Rates start to go up, but the cycle is still expanding, right? Just at a slower rate. So it's not bad, it's just not as good as where we've been. That is the same for the equity market. We can still see returns positive, which is historically what we've seen, but it's just not the type of returns that we've seen previously. And why is that? It's because the first two stages, you get multiple expansion and earnings growth. And in the middle stage here, which is where we are now, multiple expansion is gone because rates are going up, you get earnings. So that's that. So the last part is sort of, how can you benefit or where do you not want to be? Remember this, is that equities are an interest rate sensitive asset. Housing is an interest rate sensitive asset. So if interest rates are going up, something's got to change here and the return is going to change. That's where we're thinking about it, and the volatility will change. But if you're really more concerned about rates and inflation than me, then just stay away from areas that are in the direct line of fire of these, which is stocks which don't make money, stocks which are on high PE multiples, stocks which had that had very strong inflows. What will benefit from higher rates? Well, inflation hedges, which is commodities, obviously. Real assets tend to perform well. Stocks which have inflation resets, which can be infrastructure. Some parts of real estate can also have that. Financials and banks do very well in rising rate environments because you get margin expansion and you get yield curve sort of steepening. And also you can have, and this is relative, so it's not an absolute, you can also have areas that do better relatively speaking. So this tends to be areas with pricing power, so staples and healthcare and those sorts of things. So there are ways to do it. And again, maybe one more point is we've been very tied into style. From an equity market perspective, should I buy growth? Should I buy value? How should I be positioned? When we start to see a maturing economic cycle, the style call becomes less relevant. Good stocks become more relevant than actually choosing the style. And so just be aware of that. So I get asked all the time, well, should I buy value or should I growth? I say, well, buy good stocks, right? If that's what you want to do, it can be value or growth. And that's the backdrop that we feel is kind of, sorry about that, I was a bit long.
Jason,
get a bit excited about, talking about the equity market.
I love that comment. Good stocks over style, regardless of value or growth position. I think that's fantastic. For the people on the call, would love, if there are any questions, I'd love for them to start, just throw them in the chat and I will raise them with Jason and Jonathan. And whilst they're coming in, I'll just quickly keep going. I think, Jonathan, anything to add on that? I suppose it was a question I was going to ask you around, would you agree that, based on the upward revisions across economic markers such as our GDP, the economic outlook's actually looking, pretty positive. And based on some data that you put out a little while ago, we're looking at economic dividend of around $47 billion over the next few years. So anything to sort of add on the health of the economy and where we're heading?
Look, I think the picture is pretty clear, right? We're looking at an economy that's doing really well. We're seeing a global upswing in growth, so the backdrop is really good. Interest rates will definitely be going up, as Jason mentioned, and that's because the economy is operating well. We've got an unemployment rate which is trending towards 50-year low, but we've still got inflation not completely out of control. So there's really a lot of really good things to like about all the numbers you're seeing out of Australia at the moment. I suppose just on the point of where interest rates go from here, I agree with Jason. Who cares when rates actually start going up? We know they're going up. You can see that fixed rate interest costs on homes have already started increasing. So you can't get a 3-year fixed rate loan where you could a few months ago or even a year ago. They've gone up over a percentage point now. You're seeing it in bond yields as well. They've gone up, sort of breaking the 2% barrier now for 10 years. So interest rates are lifting right across the economy, even if the Reserve Bank isn't lifting rates. So that's a clear sign that they're about to go up. And I suppose where they get to, we've done quite a bit of thinking. I don't know, the neutral rate for us is probably around 1.75%. So that's the rate that's not either contractionary or expansionary, for those people that are unaware of the concept. But that doesn't mean that we don't see it go beyond that 1.75 rate, right? You might go above it for a period of time if inflation requires it. Or you might not go near it. You sort of can see a lot of views out there from different banks, some saying 2.5, some saying 1.25. So there is that. And I suppose we don't really know where that number is until we start seeing the effects on earnings and we start seeing the effects on the economy and inflation. So that's just one sort of thing to think about when you're thinking about higher rates and where they get to.
Yep, fantastic. Jason, one for you. A question's just come through on the price of iron ore. Any thoughts on where you think that's going to from here?
I think that you should give that one to Jonathan.
Jonathan? Anyone? That?
I mean, they're going to go up. And they're going to look. They're going to go up
to the dartboard, or
yeah. Look, I think they're going to go up. They're going to go down, right? And that's a pretty bad answer, but. They've gone up again recently, and that sort of off the back of a sort of a longer term decline, or a more recent decline. So, they're probably going to go down a little bit over the next few years. And I think if you look at sort of the long term thinking about that, the Commonwealth Treasury and the sort of budget sort of looks at $55 a tonne. Sort of closer to $60 now a ton, but it's really hard to know, and even the current sort of conflicts in Europe will play a role. I'm sure there's definitely some iron ore coming out of Russia, for example. So there's a lot of unknowns essentially, and what China does and the effects of what their sort of property market is going through at the moment is sort of a big uncertainty there. If there's a tightening there, then there might not be as much of a need for iron ore over in China. But it's a big sort of question mark, I suppose.
Yep. Jason, anything to add on that?
No, look, I mean, we've probably got a very similar view here. Is that there is for us? I mean, try to forecast the iron ore price over a very short data period is, that just basically whatever price. I mean, I almost just look at yesterday's price and then will tell you where today's price is.
Yeah.
But we do feel that it's still probably sitting above where we think sort of almost that normalized level is. So a little bit of downside. So very similar to what Jonathan says. But the issue is again, as just to reiterate, his point is just that there are so many things that seem to be sort of moving and influencing the iron ore prices. Just that we almost just look at it as what is sort of the longer term view, and then sort of almost just view it in terms of where of it always sort of getting back to some type of steady state there, and that seems to be for us the safest way to think about it.
Yeah, from a strategic point of view, just don't put all your eggs in one basket.
Yeah.
Yeah. Keep to the audience, please keep the questions coming. We've got another one regarding taxation reform. Thoughts on whether our federal government consider tax reform or even increase taxes to reduce government debt, create supply, or rely on general economic recovery to create surplus?
I have a point of view here. I mean, it's a budget that is going to be about the election this year. Both sides of politics aren't going to be looking to raise taxes on people at this point in time. So you can pretty much be certain that that you're not going to get that from either side because they want to win the election. And I think both sides are going to look at the strength in the economy at the moment and see that, the automatic stabilizers, the costs that they're having to put towards unemployment benefits, for example, are going down. The amount of revenue that they're making from income tax is going up. The amount of income they're getting from company tax is also going up. So there are a lot of, I suppose, positives for the budget, given the context that the economy is in, and they're probably not going to do all that much in terms of raising taxes to reduce government debts. Now, in terms of sort of tax reform, again, I don't think there's going to be any action there. Although, I'd love to see some. There's been sort of a lot of talk about tax reform and the opportunities that it could give the economy more broadly. But I think, again, given it's an election year and it looks like a very tight election, there is probably not going to be a whole lot of impetus to disrupt the status quo at this point in time.
Yeah, look, and Andrew, look, we'd agree here. I would think that both parties need to essentially stick very close to centre left, centre right to appeal to their core constituencies in this type of very, very close sort of outcome. The second thing I'd say is just that I don't think that there is any reason why the government's going to look to accelerate its repayment of debt over the next very short while, and it certainly wouldn't do it in a way where it has to actually sort of raise the costs on households in this backdrop. We get asked a lot about sort of where debt levels are and these types of things. And while it's not nice that we've had to take on a lot of debt at a federal level, it is not at a level where they will be constrained from a spending perspective or need to address it in terms of actually getting it down such that it actually really is going to impact credit ratings and all these sorts of things at this point in time. And so I think it's almost like it's almost one of these things that sit out there, but we don't quite need to sort of address it at this point.
Okay, fantastic.
The only other thing I'd just add to that as well is that the amount of debt that they took on, while it was substantial, it was at record low interest rates. So that even the costs of servicing the debt is incredibly low. Taking out new debt from here is going to be a bit more expensive than it was a few years ago, but compared to global players, we're nowhere near needing to worry about this.
Very good. Thank you, Jonathan. Well, with only sort of a few minutes to go, and I haven't had any other questions come through, maybe we'll begin to wrap up with a couple of minutes for each person. This is what you really get paid for. What's your economic? Jonathan, we'll start with you. What's your economic view for the next 12? I think as Hewison clients, we encourage them always to take a longer term view. So rather than say, 3-6 months, what's your economic view of the next 12 to 24 months? And does the EY economic department have a view on perhaps where the ASX might be heading in that period?
We wouldn't have a specific view on the ASX, but I can give you a general sense of maybe the themes that we'd be thinking about come, say, the start of 2023. I think we're going to be in an environment with definitely higher and increasing interest rates, which will be something that the Australian economy hasn't seen for decades. We're going to be in an environment with higher and increasing wages growth, which should mean that the consumer is becoming the backbone of the economic recovery or economic expansion at that stage. And we should see, I suppose, some sort of risks around investment, and which we'd be watching around. So I'll give you a couple ups, I'll give you a couple downs. Dwelling investment is one thing that we're interested to see how that plays out, particularly given that there's such a large pipeline of work to be done now, but it'd sort of be interesting to see if that pipeline can be sustained. Investment on, I suppose, other structures and sort of more private side of things. There's some concerns around the office space, for example, around short-term accommodation and tourism, whether that can recover quickly. I suppose if I leave one final thing is this return of population growth, which will be a big thing for 2023. I think it's going to take some time for it to lift throughout this year, but we'll see students coming back. We'll see skill shortages in those low-skilled occupations, probably less significant, talking kitchen hands and chefs and the like. But I think that sort of wave of population should also add to growth prospects in 2023 and beyond.
Fantastic, Jonathan. Thank you. And Jason, your final words?
Yeah, sure. I'll answer this in three parts, just global, Australia, and equities. From a global level, outside of, an escalation in tensions for the war, we think that the next 12 to 18 months will continue to see above trend GDP growth, and supported by still below sort of neutral levels of monetary policy stimulus. So still a pretty favorable backdrop, with the capacity to absorb some downside risk before you even get back to those trend growth levels. For Australia, I like to, I'm not an economist, I like to bag them out and really say that they're never as bullish as they need to be at every single point in time. Over the last 2 years, Australia has surprised on the upside. Virtually at every level. I see no reason over the next 12 to 18 months why that cannot be the same, not with, taking out the risk at the Russia sort of level. If I said to you 5% GDP growth, which is where we think it is over the next 12 months, and unemployment with a 3 handle on it, still elevated asset prices, a consumer that has $240 billion of excess savings, why are we not positive? That's bullish. That's great. That's a perfect outcome. And monetary conditions, which are going to tighten, but even further down sort of towards the end of the year. Okay, that's pretty good to me. So that's my side. And then on equities, again, the bull market's still intact. It hasn't been broken yet. And we think for Australia that you can easily achieve 8 to 10% returns, not as strong as what you've seen over the last sort of, few years. But if you put a 4 to 5% dividend yield, which is where actually dividend yields are at the moment, and get just a little bit of earnings growth, that's pretty achievable. If you actually say that you can get 10% earnings growth, 10% growth from Australian equities in a year where actually you're probably likely to get negative returns from fixed income, including credit, that's a very strong relative call for equities, in my opinion. And there are ways to de-risk your exposure within equities without sort of just saying, I'm going to buy the index, right? You don't always have to do that. The last thing I'll say is that in terms of sort of how everyone else's wealth is generally sort of, distributed, which is housing, is, clearly sort of the affordability is going to change. But it's also a function of the proportion you spend on your mortgage, your income growth, the pass-through of mortgages, all of these types of things. We think that maybe you'll still eke out some positive gains in housing this year, very minor, but maybe sort of, very, very low single digits before you start to see a bit more pressure come through in 2023. But if you actually take some very easy assumptions around income growth and pass-throughs, we kind of think that by the middle of 2024, you might see housing affordability down, maybe it's about 15%, which means if it's directly correlated with prices, could that happen? Yes. Is that bad when you think that over a 2-year period that you might get 6 to 7% declines? That is not going to destroy the economy. It might get a few people on the edge. But again, we need to get back to some normalization in terms of how we think about returns from assets and some of these other things, without the expectation that that something that turns a little bit more negative is going to bring the whole thing down. And so I will say this, is that I'm not a bullish strategist. I want to just be right. So when it's going down, I want to be right. When it's going up, it's going to be right. But I think that for Australia, this backdrop that Johnathon, for large parts, we're pretty aligned, is quite supportive for risk assets and equity market.
Jason, just whilst we've got you here, I know we've just ticked over one past, but just an interesting question. I mean, you mentioned something about buying the index before. Now, if you bought the index in October 2007 through to today, you'd be lucky to have made 10%. Now, whereas you've got, obviously you've got the US market, which is obviously very tech focused, but I mean, the US market's what, three times as high as what it was of its previous high. Why is that?
It is the composition. So in fact, the annualized returns, and you're looking at just a capital return. So Australia, let's not discount the fact that Australia does have a yield. So the actual return since 2009 annualized for the US is about 18 and a bit percent, and for Australia it's about 13. So 5% annualized over 13 years is actually quite a lot, right? It's actually huge. So there has been a significant difference here. Part of the reason was also the starting point. Australia actually didn't drop as much during that period, so our base didn't need to move up. But it's largely just composition, and so the US is largely sort of growth biased, which is technology, healthcare, parts of industrials are also structural growth. and Australia really doesn't have any of the real structural growth parts. Our technology sector is so small, it's largely irrelevant. And then you've got, financials, which is largely banks, which is 20% of the market, and then resources, which is kind of all up and down. So we've just missed that structural sort of growth, kicker for us, which really no one should be surprised about, though, because we've always said that, or not we, but anyone who works in the markets always knows that Australia's a low beta market. The problem is not that it hasn't been low beta on the upside. The problem for me is that it's actually not always low beta on the downside now, and that's because because there's so much money now chasing quite a small market that it actually is accentuating these declines. And you wake up one day when the US is down 2. And, by the end of the day here, we're down 3. And it's like, hang on, we're supposed to be a low beta market. What the hell's going on here? And it's basically because, we've got a lot of sheep that always follow what's going on in the US. And they're funneled into, there's too much money in very small areas. So, it's going to be, I think that one of the issues that we will have going forward is just simply, the super money, the amount of money that sort of is around. The equity market is just not large enough to basically sort of absorb that, and it's very simple, right? A developed economy's equity market in the end should be roughly around the same size as the economy, 100%, which is sort of can get bigger or larger. In China, it's 50% of the size of the economy. In the US, it's 110, 20 or something. And for here, it's roughly about the same, But there's so much money now chasing a market which is just not growing in terms of IPOs and issues and these types of things. So that goes that's the point there. But I also feel that the unfortunate part is that just at the time where global equity returns are probably slowing down, because the US is the biggest part of that, it's 50% of global markets, and their returns are slowing, is the time where actually a lot of investors here domestically need to structurally upweight their allocations towards offshore equities. So we want to be careful about that. But I would say this is, very easily, equities are going to outperform sort of, bonds, clearly, because we think bonds are probably giving you another negative return. Real assets, which is 3 parts: commodities, real estate, infrastructure. Commodities, cyclical and structural appeal. Real estate, cyclical appeal, because that's largely a return to work function. And infrastructure, which is a structural appeal. And then alts, which you really need in your portfolio as well. So there are ways for thinking about positioning in a slightly less favorable equity environment without sort of becoming too overly concerned.
Yep. Okay, fantastic.
If I could just add just one 5-second point, which kind of talk to Jason's point. If you look at the S&P 500 in 1998, the top 5 companies are GM, Exxon, Ford, Intel, Mobile. In 2021, it's Apple, Microsoft, Amazon, Facebook, and Alphabet. In the ASX, it's NAB, Rio Tinto, BHP, CBA, and Westpac in 1998. And then in 2021, it's BHP, Rio, CBA, CSL, which is a new one, and Westpac. So basically, it shows you one economy going structurally changing completely, and another economy status quo.
Yeah.
But also, can I make and Andrew, I also think that this is also why it's becoming harder for some of the domestic international managers, because actually sort of, everyone at an international level has been able to ride this structural tailwind of sort of a very few stocks. If you've got a very few stocks, right, you just bought some, some Facebook or some Microsoft or some Amazon, and you've been able to really outperform a global index, which has 5,000 stocks in it. It's becoming harder now, and I think you're starting to see that in terms of some of these global managers, who sit here, where actually owning and just continuing to own some of those structural growth stocks is not quite as easy as what it's been in the past.
There's another hour's worth of conversation, and perhaps for some people, listeners, it could have been another more interesting hour than the previous. So maybe we'll get together in the future and keep talking about that component. But we're out of time. You guys have got the day to get on with. So I just it's been an incredible privilege to have people of your caliber on the call today, Jason and Jonathan. So thank you so much. For the viewers there, we'll be, I'll be summarising this through our channels and LinkedIn and so forth. So don't forget to jump on the Hewison Private Wealth LinkedIn page to see those summaries and so forth. Do you both share updates on LinkedIn?
Yeah, I do.
Yep. So, search Jason and Jonathan too, if you want to get their updates in the future. Gentlemen, thank you so much. Thanks to everyone watching today, and have a great day.
Thanks, Jonathan. Thanks.
Thanks.
See you.
Bye.
Thanks, guys.